A key question for markets: how will the Fed react to new U.S. tariffs? Senior economics reporter Steve Leisman joins us with a look at that angle of the story. How can they react when you don't know how long it's going to last, Steve? And I would think they'd have to wait for some data points, since they, by definition, are data dependent. Would they take some preemptive? Would they make some preemptive moves? I can't imagine.
The preemption right now, Joe, is the talking and the gaming out and trying to give people sort of a heads up of how they're thinking about this. We got some of that yesterday. Tariffs, Joe, create this double-edged growth scare. It potentially depresses economic activity, at least for a time, while raising prices. And that could sort of tie the Fed's hands in its ability to respond. Fed officials seem to be telegraphing just what Joe said. It's going to be difficult for them to cut rates into a tariff-induced rise in prices. At best, they're saying they need to be patient to see how the price increases work through the system.
I'm going to be trying to parse out what are price level effects from what are inflation effects. What are first round effects, price level effects, from second round effects onto other prices and potentially wages, et cetera, right? I'm going to try and understand what is happening. If we're only observing price level effects, which are expected to phase out over time, then a look-through strategy may be the right thing to do.
That was Alberto Musalem, president of the St. Louis Fed. So if that's the case, then the Fed would likely look through the tariffs' inflationary effects. But if inflation expectations rise, Musalem and other Fed officials suggest the Fed may have to respond by keeping rates where they are or even hiking. Markets have boosted the probability of rate cuts amid weaker economic data and this increasing concern about tariffs. There's an 85% probability now of a first cut this year in June and a 78% chance of a second cut in September. All that might be optimistic and presumes weakening growth with no lasting inflationary impact. Krishna Guha of Evercore ISI says the road to that June cut would run through moderate tariffs. That means backing off the current levels against Mexico and Canada, coming with something other than that. Weaker job growth, declining inflation, and, of course, contained inflation expectations. Musalem and other Fed officials have brought up the mistakes the Fed made in the 70s, where monetary policy did not respond correctly to inflation. Joe, they've made clear they're not going to be making that mistake this time.
Yeah. It is, by definition, I think tariffs are, it's like the worst of both worlds. They're stagflationary, aren't they?
At least for a time they could be. You know, Joe, the other side of that is there's supposed to be some investments in the U.S. that would come from that. I think there's a big difference in timing. You just don't build factories and hire people and do domestic manufacturing. Right. The other problem, Joe, is that one of the commentaries I read yesterday suggested the problem with today's tariffs are that they make likely and even necessary the next set of tariffs, which are coming in April. So unless you do those tariffs, you make the North American supply chain much more expensive. You price it out.
Because, you know, the inflation, you'd want to raise rates. For a weakening economy, you'd want to cut rates. So it's like you're in a pickle. You're in between a rock and a hard place.
Exactly. And the trouble, Joe, is that you remember Powell famously brandishing the 2018 Fed staff study about how to respond to the tariffs then. The context is different now, and that's something that bothers the Fed. You have higher inflation. You just had a bout of inflation. You're starting at a point where you're above the target. So the concern here, and you've seen this in some of the surveys of inflation expectations, even while the market measures of inflation expectations are relatively low, the survey measures are high. So the Fed has to watch that, and that's really going to determine how they can respond. If inflation expectations remain under control, they can respond with rate cuts to weaker growth.
Right. Okay, Steve. Thank you. You think we'll be talking about tariffs in 6 months? I don't know.
You know,
can't tell.
Joe, that's an important question because some of the folks at the NABE conference I've been at think this is just another bluff. This is another kind of going to come off it. I don't know. So maybe not.